Have you ever wondered why some wealthy people seem to pay almost no taxes while you're stuck handing over chunk after chunk of your hard-earned money to the government every year? What if I told you that the tax code isn't actually designed to punish you, but rather to reward certain behaviors, and that once you understand these hidden incentives, you can literally make the system work in your favor instead of against you? Today, we're diving deep into 10 unconventional strategies that can transform your relationship with taxes, from dreading April 15th to actually looking forward to it, because you'll know exactly how to keep more of what you earn. Before we jump into these game-changing strategies, let me share something that completely shifted my perspective on taxes. Most people view taxes as this unavoidable burden that just takes money away from them, but successful investors and business owners see taxes as a roadmap. Every deduction, every credit, every incentive written into the tax code is essentially the government saying, hey, we want you to do this specific thing, and if you do it, we'll let you keep more of your money. It's like having a treasure map where X marks all the spots where you can legally reduce what you owe. The first strategy that most people completely overlook is maximizing retirement contributions, but not in the way you think. Everyone knows about 401k plans, but here's where it gets interesting. If you're self-employed or have any side income at all, you can open what's called a SEP IRA or a solo 401k. These accounts allow you to contribute massive amounts compared to traditional retirement accounts. With a solo 401k, you can contribute up to $67,500 per year as of 2025. And if you're over 50, you can add another $7,500 in catch-up contributions. That's potentially $75,000 that you're moving from taxable income into tax-deferred growth. But here's the kicker that financial advisors don't always mention. You don't need to be running some massive business to qualify for these accounts. If you do any freelance work, sell things online, have rental income, or even drive for rideshare companies, occasionally you likely qualify. The key is having what's called earned income from self-employment, even if it's just a few $1,000s per year. Strategy number 2 involves something called tax loss harvesting, and it's like getting a discount on your future gains. Here's how it works. Let's say you bought some stock that went down in value. Instead of just holding it and hoping it recovers, you sell it to realize the loss for tax purposes. This loss can offset gains you made elsewhere, or even reduce your regular income by up to $3,000 per year. The beautiful part is you can immediately buy back a similar but not identical investment, so you stay in the market while still claiming the tax benefit. The third strategy revolves around understanding the difference between ordinary income and capital gains, because the government taxes these very differently. Ordinary income from your job gets taxed at rates that can go up to 37% for high earners. But long-term capital gains, meaning profits from investments you held for more than a year, get taxed at much lower rates. For many people, it's 0% on the first $44,625 of capital gains income as of 2025. This means if you can structure more of your income to come from investments rather than wages, you can dramatically reduce your tax burden. Strategy 4 is all about geographic arbitrage and state tax optimization. Some states have no income tax at all, while others charge over 13%. If you work remotely or run an online business, you might be able to legally change your tax residence to a state with lower or no income tax. But here's the crucial part: you have to actually establish real ties to that state. This means spending the majority of your time there, changing your voter registration, getting a driver's license, and establishing other connections that prove you're a legitimate resident, not just trying to dodge taxes. The fifth strategy involves what's called income timing, and it's particularly powerful if your income varies from year to year. The idea is to bunch income into high-earning years when you're already in a higher tax bracket anyway, and push deductions and losses into those same years for maximum impact. Conversely, if you know you'll have a lower income year coming up, you might defer some income to that year when it will be taxed at a lower rate. Strategy number 6 focuses on maximizing business deductions, even if you're not a traditional business owner. The tax code allows you to deduct ordinary and necessary business expenses, and the definition of what qualifies can be surprisingly broad. Home office expenses, business meals, professional development courses, equipment and supplies can all potentially be deductible. The key is maintaining detailed records and ensuring everything you deduct has a legitimate business purpose. Here's where strategy 7 gets really interesting, and it involves understanding depreciation. When you buy business equipment or property, the tax code often allows you to deduct the cost over several years, or sometimes all at once through something called bonus depreciation. This means you can reduce your taxable income today, even though you'll pay for it over time through financing. It's essentially getting a tax deduction for money you haven't even spent yet. Strategy 8 revolves around tax-advantaged accounts beyond just retirement plans. Health savings accounts, or HSAs, are often called the ultimate tax-advantaged account because contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. After age 65, you can withdraw money for any reason, though you'll pay regular income tax on non-medical withdrawals. But here's the secret: many people don't know you don't have to spend HSA money immediately. You can invest it and let it grow for decades, then use it to pay for medical expenses in retirement. The 9th strategy involves charitable giving, but with a twist that can actually put money back in your pocket. Instead of donating cash directly, consider donating appreciated stock or other assets. You get to deduct the full market value of the donation while avoiding the capital gains tax you would have owed if you sold the asset first. Plus, if you're strategic about it, you can donate the appreciated asset, then immediately buy it back with cash, essentially resetting your cost basis for future tax purposes. Our final strategy, number 10, is about understanding the power of entity structure. Depending on your situation, forming an LLC, S-Corp, or other business entity can open up entirely new categories of tax benefits. S-Corp, for example, allow you to potentially save thousands in self-employment taxes by paying yourself a reasonable salary, then taking additional profits as distributions, which aren't subject to Social Security and Medicare taxes. But here's the most important thing to remember about all these strategies: they're not one-size-fits-all solutions. Your optimal tax strategy depends on your specific income level, family situation, career path, and financial goals. What works brilliantly for someone making $60,000 per year might be completely wrong for someone making $200,000. The tax code is incredibly complex and changes frequently. So while these strategies provide a great starting point, you should always consult with a qualified tax professional before implementing any major tax planning moves. Think of this video as giving you the vocabulary and concepts to have more informed conversations with your accountant or financial advisor. The beautiful irony of taxes is that once you understand the system, it becomes less about how much you make and more about how smart you are with what you make. The wealthy don't pay less in taxes because they're cheating the system. They pay less because they understand the system and use it exactly as it was designed. So which of these strategies resonates most with your current situation? Drop a comment below and let me know what your biggest tax challenge has been. And if you found this video helpful, make sure to subscribe, because we're constantly exploring these kinds of practical financial strategies that can make a real difference in your life. Remember, the best tax strategy is the one you actually implement. So pick one or two of these ideas and start taking action today.